Federal Reserve action certainly stimulating the markets today, that's for sure. But is the short-term gain eventually going to create long-term pain? Ben Pace is the U.S. Chief Investment Officer with Deutsche Bank. He joins me right now. Keith Springer is CEO of Springer Financial Advisors. And David Kudla is CEO and Chief Investment Strategist with Mainstay Capital Management. And also in the conversation, our own Steve Leisman and Rick Santelli. Gentlemen, good to see you. Always wonderful to have you on the program. Ben Pace, your thoughts on the Fed action today?
Well, as market participants, Maria, we love it near term, right? The only thing we're not certain about, and there's questions about whether this is the all clear sign for the kind of price earnings multiple expansion that we've been looking for. We tend right now to doubt it because the economy's slow. You have your fiscal issues. Corporations are still sitting on the sidelines waiting for resolution of the tax and regulatory policies, and they're the ones that have to spend to really bring the unemployment down. We don't know how much Ben Bernanke and the FOMC could really do about that right now.
Steve Leisman, what do you look for in terms of the next catalyst here? Will you be focused on how this market trades as the Fed is buying that $40 billion in MBS a month?
You know, I think a new important barometer, Maria, is going to be actual mortgage rates. And then the housing market. It looks like Ben Bernanke, one of the conduits he wants to use to try to get the economy going is the old conduit, which is the housing and the interest rate sector. We also know that automobile sales have been below their historical average. So that's another place you could look for sort of the Fed theory showing up in the real economy. And then, of course, whether or not all of that translates into jobs. I mean, I had two thoughts on what you were saying before. I'm not sure that there's new information on the economy here from the Fed. I think what's pretty clear is that the Federal Reserve is addressing an existing problem. That's lackluster growth, stubbornly high unemployment. I don't think their forecast, and they're harboring deeper doubts about the forecast in this action today. I think they're saying, you know what, we've been through this for a while. It's not performing the way we want it to perform. We need to do more, press harder on the accelerator. I'm not sure there's a pessimistic message in this action today.
Keith, what do you think? What's your take?
Well, free money forever. It's a great country. Who wouldn't love this? But we got to remember, a minute ago, Maria, you said that the Dow was back to where it was 5 years ago. Investors haven't made any money in the last 5 years or 10 years. They really need to focus on income and dividends and not take that mentality of all in, all out, trying to beat the market. The key is to get the extra income or extra dividends, because that's where the returns are going to come from. At least they put a floor in here by putting all this liquidity, which will probably prevent a market crash anytime soon.
Yeah, it's a good point.
All this free money isn't going to help long term. It's just going to, we've got to look for dividends to get some return in this market, and that's what we do for our clients. I'm still finding 5, 6, 7% yields.
5, 6, 7% yields. Wow. Does that change if taxes go up on dividends?
Well, it certainly will, but we don't think that's going to happen. And most likely, they're going to fix the fiscal cliff. I expect them to extend it a year, probably push it off. This Congress doesn't like to solve problems. They're just going to push it off for a little bit. But MLPs offer some tax advantages. There's still 5, 6, 7, even 8% yields, preferred, some corporate bonds. There's a lot of returns out there, a lot of opportunity if you know where to look. And that's where the opportunity for individual investors lies. It's what we do for our clients. But taking all the risk in this market is just crazy. It's ludicrous, because when it falls, it's going to go, fall like a rock.
Well, I'll tell you one thing, Rick Santelli, the move today was fast and furious. As soon as we got that news at about 10 after 12 in the afternoon, the markets were wild.
Yeah, the herd mentality. I don't know that there's a lot of intelligence in the move. I'll tell you what, if Ben Bernanke really wants to affect mortgage market, Maria, he shouldn't buy mortgages. He should sell them. He should sell them on TV. He should say, hey, come and I'll originate a mortgage for you, because he'd have a lot better luck doing it that way. I've had 35 emails from big mortgage originators, and they are saying things like, today is the easiest day ever to take an application for a mortgage, but it's also the hardest to actually get one, and that isn't going to change.
David Kudla, what about you? How are you allocating capital today? And does it change post-Bernanke comments and the Fed?
Well, I think Steve Leisman is right. This has been telegraphed for a while by the Fed. And, so I think that, our barbell strategy to equities works very well. We like on one side of the barbell, the high growth areas, NASDAQ 100, cyclicals like technology and home builders. On the other side, I agree with Keith, the high yield plays work well. High yield bonds, preferreds, high dividend paying stocks give us diversification, steady the portfolio. All the areas I just talked about benefit from this Fed announcement and will continue to do well in this environment.
in terms of next hurdles for this market, is it earnings? Is it the election? Ben Pace, where are you in terms of next moves or catalysts for this market?
Well, you know, the election's a couple of months off. I think the third quarter earnings season, the pre-announcement season is starting right around now. Texas Instruments came out with a little bit of a negative pre-announcement, so I think you're going to have that as a little bit of a headwind here.
If you look at S&P Capital IQ, they're basically saying earnings will be negative in the third quarter.
Well, I don't know if it's going to be that bad, but it's going to be mid-single digit positive with maybe a little bit of disappointment in revenues like we saw in the second quarter. So I think that's a bit of a problem as well.
All right, we'll leave it there. Gentlemen, good to have you on the program. Thank you so much.
Thanks, Maria.
We will see you soon as we continue.